Dear Chairman of the Governing Board of the Swiss National Bank, Thomas Jordan, dear colleagues from ETH, from all over the world, ladies and gentlemen, dear guests, but of course most importantly, dear Professor Taylor, it is a great honor and pleasure to welcome you all here to ETH Zurich for the Karl Brunner Distinguished Lecture 2017. My name is Lino. I'm the president of ETH Zurich, and I have the very, very great pleasure and honor to welcome you all here to ETH. You may have noticed when you came in that this building is currently very busy. The explanation is simple. We had a record new enrollment. 20,000 students are now studying at ETH. And this is very good because we are witnessing dramatic changes in our society, particularly also in the economy of our world. Many things are happening, and these changes pose problems, challenges, but also many opportunities. And I believe that these young people that are studying here at ETH, as in every good university, will be the ones that drive this development forward. The tremendous power of digitalization, of course, I cannot avoid to mention this effect, is transforming whole industries and bringing up new business models that 10, 15 years ago were completely unthinkable. And I can tell you just this, we haven't seen the beginning yet. There is much more to come. From a Swiss perspective, this is particularly interesting to know. And one of the main drivers, of course, in this country is the finance industry. And we will be interesting to see what happens. It was Bill Gates who said many years ago that banking is necessary while banks are not. Well, you can interpret that in whatever way you want to, but I'm sure that technology as blockchain, artificial intelligence, data science will undoubtedly redefine not only banking, but every economic sector as well. Economy, what models and theories will help up the changes? What theories, what ideas will be able to describe, tame these disruptive forces? What consequences will these drivers have on growth? The labor market, a very big concern for many in this country and all over the world. And what roles will innovation play in this picture? These pressing questions are not just a matter of academic debate, but they have a tangible relevance to politics and society. It is therefore very important that people like you, Professor Taylor, think about things like that, and we are very much looking forward to what you're going to say. Your research has recently focused on these principles, how monetary mechanisms should be applied internationally. I'm not an expert in your field, but I know that what you're doing and your colleagues is extremely important to the welfare of this planet, and I'm therefore looking very much forward to your thoughts. Thank you very much for coming again to ETH. Thank you all for coming tonight here to this university. And with this, Thomas, I would like you to take over the floor.
Ladies and gentlemen, I'm very pleased to welcome you to the 2017 Karl Brunner Distinguished Lecture. The Swiss National Bank established the Karl Brunner Distinguished Lecture Series to pay tribute to academics whose research is of particular relevance for central banking. With this annual lecture, we want to reach a wide audience, including, in particular, students. For this reason, today's event is taking place at the ETH Zurich, which is internationally one of the most renowned academic institutions. I would like to thank the president of the ETH Zurich, Professor Lino, for making these fantastic premises available to us. This year, we are paying tribute to John B. Taylor. He is one of the world's foremost economists. John's work is characterized by keen interest in highly relevant questions from both an academic and applied point of view. He has made major contributions to economic theory. In addition, by bridging the divide between theory and practice, he's one of the few economists to have had a profound impact on economic policy and thus on macroeconomic stability. But ladies and gentlemen, John is also a very effective teacher. Just let me give you one example. Did you know that Tiger Woods, the famous golf professional, was his student in the introductory class at Stanford? Well, John taught Tiger about opportunity costs. Immediately afterwards, Tiger left college and joined the Pro Tour. Clearly a decision that paid off. But back to John Taylor again. Today, he will talk about ideas and institutions in monetary policy making. Before giving him the floor, I will briefly introduce him. Born in Yonkers, New York, John Taylor earned his AB from Princeton University and his PhD from Stanford. He taught at Columbia University from 1973 to 1980 and at Princeton University from 1980 to 1984. And since 1984, he has been teaching and researching at Stanford. John is the perfect economist. He's outstanding as a researcher, policy advisor, and teacher. In acknowledgement of his exceptional services, he has received a number of prestigious awards for excellence in all these three fields. Let me say a few words about each of these areas, beginning with John Taylor, the researcher. His research topics range from work on rational expectations to wage and price dynamics, macroeconomics, econometrics, fiscal policy, and of course, monetary policy. He has written an impressive number of influential articles in leading journals and in important books. It is impossible to summarize his research in a few sentences. Therefore, I will limit myself to two topics. The first topic dates back to the second half of the 1970s, when John initiated a research strategy that would have a profound and lasting impact on our profession. It was a time when the new classical macroeconomists were claiming that monetary policy was powerless when it came to steering the economy. This challenged both the Keynesian and the monetarist views. John quickly accepted the new concept of rational expectations. However, he rejected the assumption that markets always clear and that prices and wages are perfectly flexible. His research showed that as a result of staggered wage contracts, monetary policy, even if anticipated, can be useful for stabilizing the economy. This restored the proposition of Keynesian and monetarist models that even anticipated changes in money affect the economy. Now, the second topic I would like to highlight is a recurrent theme in John's research agenda. This is his deep interest in rules for monetary policy. John's research has always emphasized the importance of rule-like, systematic behavior for monetary policy. However, by the late 1980s, many people were arguing that efficient rules would have to be very complex and expressed severe doubts about the practicability of rules for monetary policy. So John decided it was time to write down a workable rule that was consistent with his research. The result was a simple equation to guide interest rate decision at the Fed. The equation related the policy rate to inflation and unemployment. When he presented his rule at the Carnegie-Rochester conference in November 1992, he did not regard it as a big deal. It turned out quite differently. His paper, published in 1993, has become one of the most cited works in macroeconomics. The rule became known as the Taylor Rule. My experience at the Swiss National Bank testifies the importance of the Taylor Rule. For us, the Taylor Rule derives its appeal from three features. The first is its simplicity in describing the behavior of different central banks by estimating the policy reaction to deviations from the inflation target and to the output gap. The second is its quality as a benchmark in assessing the current stance of monetary policy with respect to the historical average for a similar macroeconomic situation. And thirdly, the Taylor rule is appealing because it sets the standards by which monetary policy is introduced in macroeconomic models for forecasting and simulation purposes. The Swiss National Bank's monetary policy focus is on maintaining price stability, and we do not follow any explicit rule for setting the short-term interest rate. However, the Taylor rule serves as an important indicator in our decision-making process that helps us to conduct a systematic policy. Having talked about John the researcher, I would like to turn now to John Taylor, the policy advisor. Time and again, John has merged research with policy making. On this account, his record is long and outstanding as well. He served as a member of the President's Council of Economic Advisors from 1989 to 1991. He was on the panel of economic advisors of the Congressional Budget Office from 1995 to 2001, and from 2001 to 2005, he served as Undersecretary of Treasury for International Affairs. His responsibilities including setting up a new currency in Iraq and getting terrorist financing under control. He worked on economic reconstruction in Afghanistan and on coordination of financial policy with the G7 countries. All in all, an impressive job. Currently, John is a member of the G20 Eminent Persons Group on Global Financial Governance, which aims at improving the functioning of the global financial architecture and governance. No less fascinating is John Taylor, the teacher, in both quantitative and qualitative terms. On the one hand, he has given countless speeches, hundreds of lectures, written several textbooks, and developed online courses. On the other hand, he is known for mixing teaching with entertainment. Indeed, John does not hesitate to use special didactic techniques to help students understand and remember material. During his classes, to cite just one example, John enters into a humorous dialogue with Adam Smith, revealing deep enthusiasm and dedication to the job. And by the way, this example is quite remarkable for someone who describes his humor as mostly deadpan. So it generally takes a few lectures before his students are able to figure out when something is actually a joke. Having talked about John's three occupations separately, I should emphasize how well they interact and stimulate one another. Research is integrated into college lectures. Government work has enabled him to understand policy constraints, while this, in turn, has stimulated research. Economic research, John once wrote, is most exciting and productive when it is policy-driven. Karl Brunner could not have agreed more. Coming to the end of my remarks, I would like to repeat how profoundly John Taylor's thinking has affected central banking. For this, he earns our deepest respect and gratitude. I'm certain that this lecture will give us much new food for thought on crucial issues. Ladies and gentlemen, please join me in welcoming John Taylor with a big round of applause. John, the floor is yours.
Thank you, Thomas. Thank you very much. Thank you. Okay. Thank you, Thomas, for a remarkable introduction and so carefully thought through, and I appreciate it greatly. I really do. And thank you and the Swiss National Bank for inviting me to give this lecture, which is an honor and a pleasure beyond imagination. I also want to thank my hosts from ETH for making this occur at a university where I've spent many years and enjoy, as Thomas indicated, enjoy teaching greatly. In fact, on Monday morning, I will be back at Stanford teaching what we call Economics 1, which is the first course, which I always love to teach. And the audience, it'll be like you guys, actually. And I have to think about this deadpan stuff. I should probably start with something really crazy at the beginning. I used to dress up in costumes, but unfortunately people took videos of my costume dancing, and now you can see it on YouTube, so I don't do that anymore, which is probably just as well. I don't look so good in the costumes. But I appreciate the invitation and the venue, and thank you all for coming. Actually, exactly 10 years ago today, I spoke in Zurich, and it was right before the financial crisis, so I have memories a lot. I'm thinking recently of all that has happened in that decade, on that 10-year period. And in some sense, my discussion today, which will draw on older research and recent research as well, I think reflects how different the world is in many respects since that time. I knew Karl Brunner well, long time ago, of course, and he had so many ways in which he integrated his thinking, his ideas with policy, and that's what I remember most. And there's many different examples of this, but perhaps the one that I have most vivid memories of was the Carnegie Rochester Conference Series, which he started along with his student and collaborator and good friend, Alan Meltzer, who just passed away this year. But that was an example of not just thinking about the economics and the theory and the empirical stuff, but finding ways to think about how the institutions of policy operate. And it also was good, and it brought people like me, just beginners, in to interact with policy and think about policy. It wasn't just the technical things or the models, it was interacting. And one of my first opportunities, which I thank Karl for, was to discuss a paper which turned out to be extraordinary by Ed Prescott and Fid Kinlan, and they presented it at this conference. I had the chance to be the discussant. It was really a thrill. Later won the Nobel Prize. And I served on his advisory committee for, I look back, 20 years, hard to believe. But those are the kind of things that I remember. He also established the Shadow Book Market Committee, had similar kinds of focus. Journal of Money, Credit, and Banking, Journal of Monetary Economics, the conferences here, Constance and Interlaken, it just goes on, and all have this idea, this theme of not just the economics, but thinking about how it applies in practice. And I don't think any institution of policymaking was immune to this analysis. The Fed, of course, was always a topic. One time he invited the Fed, people at the Fed, to discuss the institution of policymaking. I think it surprised everybody. The forecasts were better than everybody else at the time. That is an example of looking at all the details. So today, what I'd like to do is really continue with that theme of Brunner, that Karl Brunner had. And I have some quotes here to indicate this theme, which comes from the introduction to the Carnegie Rochester Conference Series. So this was written by Karl and Alan Meltzer together, but it's really, it's important. So I want to try to apply the Brunner approach to current international monetary policy issues, and just to read it out loud, policies depend not only on the theories and evidence, but also on the structural policymaking bodies and the procedures by which policies are made, implemented, and changed. And just to paraphrase, quote, I should say, we should direct the attention of economists to major problems of economic policy and institutional arrangements. We should encourage further research on policy and on the effects of national agencies and international institutions on the choice of policy. So that's the theme, and it pervades Karl Brunner's work. I want to focus on more recent events over the last decade or a dozen years or so. And unfortunately, we don't know what Karl thought about these events. Just like many great economists, we can't ask them, and we'll never know what they thought. So it's too bad, but that's the way it is. However, in this case, we have a close substitute, or at least a hint, and that is from Alan Meltzer, because Alan was a student of Karl's, and they wrote 25 papers together, and they collaborated in almost all the examples I gave of conferences and institutions. So I'm going to quote from Alan Meltzer to get us started. And so this comes just from a little over a year ago. Alan was speaking at the annual Jackson Hole Conference, and he intervened with the following. Through quantitative easing, Fed policymakers had actually been engaging in competitive devaluation. Other countries have now followed and been even less circumspect about the fact that they were engaging in competitive devaluation. Competitive devaluation was tried in the 1930s and unsuccessfully, and the result was that around that time, major countries agreed they would not engage in competitive devaluation ever again. I would hope that from this point forward, the Federal Reserve would take the lead in trying to restore the agreement which said no more competitive devaluations. Quite strong language. Alan and Karl, for that matter, were noted for not mincing words. It's not personal criticism. This is a statement of his assessment. So what I want to do in this talk, in a sense, is consider this assessment using data, using empirical analysis, and want to come to this sense, is there something to this view of the world? It's not the way everybody thinks about it, to be sure, but it's a way that one could think of the world. So I want to start with more conventional kinds of policies, international policies with respect to interest rates, and then I want to consider balance sheet policies. And the interest rate policy is, I'm just going to refer to some research that I and others have been involved with. For the balance sheet policies, I want to bring some new ideas, which I've done for this lecture, into play. So let me start with interest rate policies. And I basically want to say that there is a sense in which central banks have reacted to each other's decisions about interest rates with their own interest rate decisions in such a way that the currency issues, devaluation, depreciation, appreciation, come into play. So I'm going to start with this chart, which I see Yun Shin in the audience. This comes from the BIS. In fact, just as a side, I'm very impressed with the way you guys here have put together my slides. Because I sent the slides originally, and Cheryl wrote back, the technician says they're too blurry. And they said, this one was blurry. It's because I took it from BIS publication and put it in myself, and it was too blurry. So they said, here's how you really should do it. So I worked hard. I don't think this is too blurry anymore. Thank you so much. I appreciate it. But this is done by BIS, and Yun has referred to it. So this simply shows the interest rate and the range of interest rates that are set by policy makers globally and just in the emerging markets. And what it shows, I think, is a quite striking similarity among the interest rate decisions of countries, and in addition, the similarity of what they would do if they were following a Taylor rule. And so on the left, doesn't matter, it's the same story on both, but you'll see starting in around 2003 or 4 or something, there became a deviation, policy became quite low compared to what this kind of rule would suggest. Then you had the financial crisis, and it was basically right on, and then it's drifted away since. And emerging markets, the rates are somewhat higher, inflation rate being higher on average, but the story is pretty much the same. So there's a connection, for some reason, between the interest rate decisions that are being made. Now, one possibility is that it's just a common shock. All central banks are reacting to the same thing, and that's, of course, what maybe some of you are thinking right now, that there's a reason to be extra low in 2003, 4, and 5, or there's a reason to be extra low now. And that's certainly one reason to think about it. But there's been lots of work, dozens of papers that have looked at this from a different perspective, and that has tried to see to what extent this correlation or this similarity is due to the fact that central banks are actually following each other. And the way that's tested is by including in central bank reaction functions the actions of another central bank. So for example, Agustin Carstens, the governor of the Central Bank of Mexico, did some regressions where he included in the Central Bank of Mexico's interest rate decision the actions of the Fed. And the Fed's actions appear as a significant variable. Other people done. I did that back with respect to the ECB in the US back in 2007, the same story. And it's been done many, many times. So there is a sense, now it could not prove, but there's a sense in which there's a reaction. And central bankers, if you talk to them, are usually not surprised about this. My first time I raised it, that I recall with the central banker, was with Mervyn King when he was governor of the Bank of England. And he said, well, what do you expect? We worry about the exchange rate. If the Fed cuts its interest rate a lot, we're going to have our interest rate lower than we otherwise would. Otherwise, the pound would appreciate. And then, moreover, if you, again, you looked at not only the actions, but the evidence, you see that. So I think it's there. It's a factor, and that's a sense in which issues about currency are affecting the decisions of the central bank. And so it has the flavor of Alan Meltzer's discussion. Now, one thing on top of this globally that you have to take into account is that if central banks are if central banks are reacting to each other, so it's not just a one-way thing, but it's a two-way thing, you think it would be if each central bank was reacting, there's a simultaneity effect which can make this worse. And I want to illustrate this with a diagram which comes from research I actually did 10 years ago at the time I was here before. But this just simply says, what if two central banks, to make it simple, just two, and there's two, and they're reacting to each other? So my example, I have interest rate in the US, or at home, if you like, I on the vertical axis, and interest rate abroad, I star on the horizontal axis. I have two policy rules, the US and the rest of the world. They're both upward sloping in the sense in both cases there's a reaction of I star and a reaction of I and I star. And the slopes are chosen to be 0.5 for the US and 1 for the rest of the world. And now you suppose there's something that moves the US interest rate down, I call that delta Z, by 1 percentage point. And so the US curve shifts down away from this picture. And this could be a change in inflation, unemployment, it could be something else. And so it shifts down, and initially what that will do is make the other country lower its interest rate. So the rate comes, first the US reduces, then the other country reduces, then as a result of that the US reduces, et cetera. And so it goes down, so there's a natural multiplier effect, and the ultimate effect is, in this case, 2. And so that's another aspect that may be going on, and it would be going on if you had reaction functions that had these properties. Okay, so that could suggest an extra movement internationally that's it's related to the exchange rate movement, that's why they're there, but it multiplies and you end up with a lower interest rate than you otherwise would have, simply because the central banks are also concerned about the exchange rate for whatever reason, either for right or for wrong. Okay, so that's in a way a review of literature that's out there. But to really be relevant to today, I have to consider balance sheet operations, because interest rate is only a part of the story. So for that, I need to think about the basic modeling framework to do this. And I thought a lot about this. The modeling framework is much different than the framework that Thomas referred to, that I worked on in the 1980s. Effectively then, you had really effectively one instrument for monetary policy. And it could be the money supply or the interest rate. And they were linked together by the way policy operated. So that's obviously not the case anymore. It's possible to have a balance sheet operation and an interest rate operation that are separate. And the one reason they're separate, the way I think about it, at least for the United States, is interest is paid on excess reserves. So you can determine that interest rate, short-term interest rate, directly, regardless of the size of your balance sheet. And so it enables there to be two instruments. And I need to think about that. So it's not just the interest rate, it's also the size of the balance sheet and the ability to affect the policy rate separately is key to that. And it's done somewhat differently in different countries, to be sure. Now, the second thing I want to take into account is which side of the balance sheet to look at, because a balance sheet got assets and liabilities. And I want to look at the liability side of the balance sheet because I want to distinguish between central banks like the Fed or the ECB that are not directly looking at exchange rates versus central banks in small open economies that in some sense can help to look at exchange rates. So the liability side of the balance sheet is going to move in any case, but in one case is going to be purchases of domestic assets, in the other case purchases of foreign assets. So I want to look at the liability side of the balance sheet, and I'm going to call that reserve balances, okay? That's going to be the thing that the Fed or other central banks move around. The term reserve balances is used in the Fed, but I'm going to create similar measures of liabilities that the Fed or another central bank uses to finance its purchases, similar to reserve balances. And so in terms of balance sheets, this is then the picture. So on the left is going to be a typical balance sheet of Fed, ECB, the Bank of Japan. On the right is a balance sheet of the Swiss National Bank. Now, of course, there's other things in the balance sheets, but these are the things I'm going to focus on. And so when the Fed buys Treasury bills or domestic securities, it finances them largely by reserve balances, by the deposits that banks hold at the Fed. That's really, they get the money to buy it. Now, of course, there's other ways to finance it. Currency is a way to finance it, and currency changes over time. But the main movements up and down that I'm focusing on are due to increases and decreases in reserve balances. And so they move very close together, not perfectly, and that's an issue, but pretty close. Similar kind of story occurs for central banks in small open economies, except for the most part, they're buying foreign securities, in the sense securities denominated in foreign currency. So I'm going to think about on the right as the Swiss National Bank, just for the sake of being specific. And on the left, I'm going to think about the Bank of Japan, the Fed, and the European Central Bank. So if there's going to be purchases of foreign securities by the Swiss National Bank, dollars, euros, whatever, it's going to be financed with these reserve balances, which you can think of as just roughly deposits that the banks hold at the Swiss National Bank. And I'm going to show you to what extent that's a good approximation. But it enables me to think about this in a common way. And so my balance sheet variable is going to be reserve balances, the liability side of the balance sheet. And so given this framework, I have a bunch of variables to look at. I must say, these are enormously complicated issues. This is a world economy. There's many central banks. There's many currencies, many economies. So bringing it down to size that you can work with is huge. So this is my bringing it down to size. Sorry. But the first four are just the measures of the balance sheet. So it's the Fed is going to reserve balances, and I give them measures. I'm not going to change the measures that are reported by the central banks. And so these are all come from central bank's balance sheet. The case of the Swiss National Bank, it's sight deposits and other sight liabilities. So those are four policy variables. The next four are also policy variables. Those are the ones that I began with. And so we have the effective federal funds rate in the US, the call money rate in Japan, the interest rate in the deposit facility in ECB, and the Swiss average rate overnight in Swiss National Bank. And so those are really those 8 policy variables. But then I want to focus on not all financial assets, but I want to focus on the currencies. And so this gives me 6 exchange rates to worry about, which I've listed here. So for example, the yen-dollar exchange rate, and it's measured so that a lowering of that is an appreciation of the yen, et cetera. And so these are all the 6 that you have to worry about with these 4 countries. Okay, so that's the key variables to keep track of, and again, it could be much worse, so bear with me. Now first, let's just look at the numbers a little bit. Okay, so first the correlations. I think this is quite striking itself. This is just the These are monthly data. The month-to-month correlations, simple correlation coefficients between these variables. Okay, so a lot of numbers, so I used some colors to help you look at it. Okay, those are the correlations between the interest rates in these countries, 4 countries, and they're all positive. In a sense, you kind of already knew that from looking at my earlier data. There's a lot of relationship between those. And also, this is not as sophisticated as if you're looking at policy rules, but there's something suggestive there. That's not just a coincidence. So the policies are moving together. Very similar to the BIS chart. However, well, I wanted to mention, is it surprising that it's 0.97 between the Swiss National Bank and the European Central Bank? So that's the big one. Okay. But let's look at the reserve balances, all positive. And so that's a sense in which there's a contagion or a correlation, whatever the word is you want, between reserve balances, not only for the large economies, but for the small economy. And so that's in a sense in which the story is going to be similar. We need to look at it more carefully than this. And then finally, the correlation between the interest rates and reserve balances uniformly negative across all of these. I mean, when I first looked at this, I'd say, this is really surprising. I think this one's a little less surprising because if you take the other stuff as given and that there's usually a negative relationship between interest rate and reserves in each country, and the fact it's positive correlations between reserves in each country, the negative pops out. Remember, these are simple correlation coefficients. Anyway, so that's what the raw data tells you. I think it's the beginning of something to think about. But let's look more carefully. Okay, so these are the actual behaviors of reserve balances, again, the liability side of the balance sheet, in the 3 larger countries or areas. It goes back to 2005, and it's labeled, so reserve balances from the Fed are blue, then the BOJ in red, and then the European Central Bank in green. Okay, so there's quite a striking correlation here you can see already, but look at it. It begins in Japan, and we know it began in Japan. Sorry, it began in the U.S. We know it began in the U.S. And that's right after the financial crisis. Originally, it was simply short-term liquidity support, but then it continued with the quantitative easing 1, 2, and 3. And it drifts down each time because the financing necessary diminishes as currency grows. But if the Fed is on its way to reduce this further from the decisions yesterday. Okay, so now then you have the BOJ. Comes afterwards. I know the question is whether this is just a coincidence or not. And then you have the ECB. Okay, so there's a sense of following. And I think the question here is as to why this is happening. And one reason, it's sometimes stated, well, the same problem is occurring globally. They're all reacting to the same problem. But maybe there's something else. Maybe the currency has something to do with this. Okay, so just a little bit of background. I've been thinking about this for a while. And what I have argued, but not based on what I'm going to show you in a few minutes, but simply on the fact that we had the U.S. quantitative easing. The yen was very strong after that. Abe ran for prime minister, won, appointed Haruhiko Kuroda. Kuroda does quantitative easing, partly because the yen is so strong, the yen depreciates, okay? That's the green, that's the red following the green. And then in August of 2014, Mario Draghi talks about, very quietly, about the strong euro, and there's a quantitative easing in Europe, and that follows. So there's at least the possibility these are related to exchange rates, even though it's not emphasized, and certainly not emphasized in the United States, or even mentioned as far as I know. But the question is, can we go a little further than that? And one thought I had, and this is just a thought. I don't want to drive this home too much. I think more work needs to be done. But it's possible to think about a multiplier effect here, too. So these are 2 equations in which I've taken reserve balances in Japan and related it to reserve balances in the U.S. And there's a huge simultaneity here, but these are just regression results with t-values obviously highly correlated, connected. And so if you have this going on where there's reserve balances or balance sheets reacting in both ways, you can get a multiplier effect, just like the interest rates had a multiplier effect. Here, since we don't have reliable, well-known reaction functions for balance sheets, you can't really do this. But in principle, you can. And if it's the case, then you get a multiplier of 2.2, just by simple algebra. So I don't think this is the way to do it, but there's perhaps an aspect of this going on. And by the way, one reason why I think this is too simple is just this previous chart. These are not simultaneous by any means. There's huge lags here. So I think you'd have to be more sophisticated. But that's possibly what's happening. It's just a thought, question mark. But let's look more carefully at the exchange rates here. So these are some equations that relate the exchange rate in between the three larger areas and reserve balances, Japan, US, and Europe. And so what I want to investigate is whether there's a relationship that you can pick out of the data. So this is hypothesized, and there's different ways to hypothesize this. I think of this almost like inverted money demand equations, where if there's an increase in liquidity reserve balances in one country, people have to be rewarded for holding this extra amount, and that's possibly the change in the exchange rate. So exchange rate probably have to depreciate before it appreciates. But there's other ways to think about this. And so the general idea is, will an increase in reserve balances in Japan depreciate the yen? Will an increase in reserve balances in the US appreciate the yen? So will alpha 1 and alpha 2 have those signs? And you can do the same thing generally here. Japanese-European exchange rate, XJE, or US Eurozone exchange rate, UE. In the case of the last one, you'd have the euro depreciating when RE went up, the euro appreciating vis-a-vis the dollar when RU went up. Okay, so let's look at the simple regressions from this based on the data you just saw. And I think it's very strong. Okay, so first the Japanese-US exchange rate, you have increase in reserve balances in the US drives down XJU, which is appreciation of the yen, and you have RJ going the other way. Okay, so that's in the data. These are t-values, which are ridiculously large, I know. But the same thing is true for the other two as well. It's quite striking. Since these equations, as you might guess, have a significant amount of correlation in the errors, it's important to adjust for that, so I just adjusted with a Newey West adjustment mechanism for the standard errors of the equations. So this drives down the t-values. They're still pretty significant. Okay, so this is my sense in which there's some evidence for the exchange rate effect of these policies. And you can look at it in different ways, but I've never quite seen it put forth. I've never seen it done, quite frankly. There's hand-waving like I have done, but I've never seen it this way. And I'm sure there's many things to think about and complain about, but it seems to be there. Now, let's also just look at some charts here to sort of back up these numbers. And by the way, the units are, and the size of the coefficients are unusually small because I have not adjusted the size. These are exchange rates on the left and millions and billions of reserve balances on the right. You saw that a few minutes ago, and you'll see it again here. Okay, so let's look at some charts. Actually, let's look at some charts first. I'll come back to that. Okay, so this is the same picture of reserve balances at the top, US, Japan, and Europe, ECB, and below is in this case, the yen dollar. So you can see the appreciation of the yen to the 120 to 80 or so during the period of US balance sheet expansion. And then you see the Japanese coming in with the green, and almost right away you have to see the exchange rate begin to move. And then you see some other adjustments, but that's what's being picked up in these regressions. So if you don't like the regression, you just want to look at the numbers or have some other corrections, you can do it. This is the exchange rate between the yen and the euro. It's basically the same kind of story, but here you begin to see some movements with the European move towards quantitative easing. The dashed lines are over on the right. The dashed lines are there, by the way, because I don't get exactly monthly data for the ECB. I need to work on that so that it's more intermittent, but it doesn't really matter. And then finally, the European dollar exchange rate. And here I think it's mainly, you look over on the right here and you see the depreciation of the euro. At roughly the same time you see the expansion of reserve balances. So that's what's going on, and there's different ways to look at it. One other way I'll just share with you in a minute. Just reserve balances in Europe and the dollar-euro exchange rate. So now you can see it, and you can see some other things now. And so if you do a regression of the exchange rate on reserve balances, and then look at the fitted and actual values, you get this. So this is just the regression of ex-UE on reserves supplied by European Central Bank. And here it's quite striking. I think you get this relationship, especially towards the end. Of course, the currency comes down faster than you see the movement in reserve balances. And that's largely anticipation from the speeches that were made in the summer and fall of 2014. Okay, so that's the evidence. Now, one other thing to show you is this counterfactual simulation. So once you have a model or set of equations like this, you can then begin to ask the question, how much of the exchange rate movement are due to the balance sheet policies, to the expansion of the balance sheet? And so all that means is you take those equations and you say, suppose there was no quantitative easing or there was no variance, and you get two different measures. So, and you can do that by just looking at the standard error of the regression versus the standard deviation of the dependent variable. So for the yen dollar, if you just look at the standard error of the regression, it's about 7. It's twice as high when you take into account all the movements due to reserve balances. And it's much higher with the yen euro, much higher with the euro dollar, not twice as high. But this is if you were convinced that the model was correct and structural and all that, then this is how you do the counterfactual. What if policy was different? How would the exchange rates differ? And there's a huge difference here. And so that makes you think that some of the volatility of exchange rates may indeed be due to the balance sheet operations. Okay, so that's the new empirical stuff to think about. And again, it's based on looking at those three central banks and measuring their policy by reserve balances. Now I want to talk a little bit about the Swiss National Bank, which is of course different, being from a smaller economy. So first, just to review a bit of the history here, I think other people think of sort of three phases in the Swiss franc exchange rate vis-a-vis the dollar and the euro. And so you had the appreciation early on, you had the period of the floor against the euro, and then you had the adjustment around the same time as quantitative easing began in earnest in Europe, and then phase 3. So that's just the behavior of the euro, the franc dollar and the franc euro exchange rate, just to think about this time period. Okay, now there was lots of activity going on here. And this is a picture of how the foreign currency purchases related to my measure of the liability side of the balance sheet. Reserve, RS is the reserve balances. I define them in Switzerland, Swiss National Bank. Okay, so these are the site deposits and site liabilities. And it's measured in Swiss francs. And so it's really highly correlated. And so if you're worried about me using reserve balances, this is where your worry should be. I think in terms of statistics, this is very, very close. And moreover, if you wanted to be more precise about it, you could. For example, the period over here where there's a gap, I believe was largely because of the issue of Swiss National Bank bonds. And so you can see that in this picture. Swiss National Bank debt certificates increased quite a bit in that period of time, and it's the same period of time as this little difference that I mentioned here. So if you really wanted to look at this, you could make it a better measure of reserve balances, but I wanted to use the same concept in each country. And each country, in some sense, has these I wouldn't call this small, but these deviations. So So I'm looking at the reserves in my work here now as a measure of the balance sheet operations to keep it comparable across central banks. Okay, so first of all, what is going on in terms of the data? So this is a picture of the exchange rate, and you can see the appreciation in blue over the scales on the left for that. And you see the purchases I shouldn't say purchases, you see the reserve balances used to finance the purchases of currency, which I just showed you a minute ago. Okay, so there's a relationship here. If you're worried about the impact of purchases or expansion of the balance sheet on the exchange rate, it looks like it's going the wrong way, but of course this is a reaction of the Swiss National Bank to the movements of the currency. So here it is a really different phenomenon. This is directly related to the currency, and it's understandable because these shocks are emanating from abroad, and there's something driving the currency, which any central bank has to be worried about. So is there any way that we can tease out the connection between these two, the fact that there's apparently a two-way causality going on? And the answer is yes, in principle, by using impulse response functions and vector autoregressions. So I want to do that here. Okay, so all this is just a vector autoregression, which takes the exchange rate, Swiss euro exchange rate, and the reserve balances at the Swiss National Bank and regresses on lags. Okay, so it's hard to interpret much from this at all, except if you did a test of Granger causality using an F statistic, there's two-way Granger causality. You cannot reject the hypothesis that there's no Granger causality in either direction. There's an impact of the exchange rate on reserve balances. You saw that in the chart quite clearly. But there's also the reverse, the impact of the reserve balances as a measure of foreign currency purchases on the exchange rate. So they're both there by an F test of the significance of the lagged variables in the other equation. So for example, the significance of RS, all the RS terms in the XSE equation, and vice versa. You also can see this through the impulse response function. So from this, you can compute what would happen if there's a shock to either XSE or RS, and that's what this is. Okay, so this is now the impulse response functions computed directly from that vector autoregression, and we'll focus on the off-diagonal elements. Obviously, there's lots of correlation on the diagonal elements of this, but on the off-diagonal elements, you're seeing the response of reserves, again, financing foreign exchange purchases, and XSE, and it's just the direction you saw a minute ago in the plot. So when there's a depreciation, let's say, when there's an appreciation of the Swiss franc, the response is to increase RS, because XSE goes down. And we already saw that. But the reverse, which we're thinking about the impact of the balance sheet operations on the exchange rate, is in the upper right, and it is also significant. The standard errors are measured by the red dotted bands, and so this is the reaction of the exchange rate to foreign currency operations as measured by reserve balances in Switzerland. So it's quite evident. So I think that's what's going on, and we don't know for sure, but that's what the data are showing, and I think if you talk to people, you'll find the same thing. So it's quite different from the operations of the other central banks. But there's this similarity that I mentioned. Now, one other thing to mention before I go on to think about the institutional responses and the policy implications is the sense in which you can see this correlation or contagion of balance sheets across the world. And so all this does is plot the sum of reserve balances in the US and Europe, just crudely just adding them up and showing that relationship to Switzerland. There's no currency adjustments here. There could be, but of course currency is moving as well. So this at least you know what you're looking at. So there's a huge correlation between the two. The scale is on the left for reserve balances, the Swiss National Bank. And so I think this is a sense in which there is a connection between what's going on, and you now kind of know why it's there, at least one reason why it's there, and perhaps you already knew this. That's true because of the concerns, I think the plausible concerns about the exchange rate. Okay, so let me take a few minutes and think about the policy implications of all this. First of all, let me summarize the results a little bit. So we've considered an evaluation of Alan Meltzer's claim that quantitative easing is, I'll put it mildly, related to currency and concerns, okay? And we looked at whether there's evidence of contagion in that for that reason. And we found it. So there's evidence of back into the interest rate decisions being influenced by different central banks. And we've now also seen that there's there's a connection between reserve balances and the different central banks, as illustrated by this picture. Okay, we've also, I think, shown that the rationale for this is not simply that there's a common shock, although that may be a factor, and to be sure. We want to come back to that, but it's not the only factor because it seems like exchange rates are part of this. And so at the least, you want to think about the exchange rates as part of this phenomenon, even if there are common factors, even if there is a global need for more liquidity, even if there is a change in the equilibrium real interest rate, which is driving things, even if that's all happening, there's something else going on here, and that is this thing with respect to the international movement of exchange rates. I think what to add is a third thing, it's in some sense this is not so good. And so one way it's to think of as not so good is to think about that counterfactual simulation, where it does seem like there's a lot of exchange rate volatility being caused by this. It's not like it has no effect. And in fact, the story of the three central banks is one in which there's successive balance sheet expansions. And the configuration of exchange rates in the end is not much different if you didn't have it. And what you have is more liquidity. And so that's the sense in which there's a danger to this, or where there's a worry about it. So there's some economic instability. And by the way, of course, many things are affected by this instability. Capital flows, which we know are more volatile. Exchange rates are more volatile in this period. People have documented that. There's a huge concern amongst policymakers that this volatility of capital flows and exchange rates means there needs to be more control over those. It's out there, sometimes called capital flow management. So that's another reason why people think they're a problem, but here they're being caused at least by part of this. I think there's also political instability that's caused because obviously there's lots of concerns about exchange rates around the world, unfair competition, manipulation, et cetera. So there's political things that come into play, which do interfere with issues related to free trade. And of course, there may be some allocation effects. We don't know, but obviously people are making decisions about what products to produce and to switching from one product to another because of exchange rate movements. So there's reasons to be concerned about this besides just looking at the data. Now, what do we do about it? So that's really the policy implications, and again, where the ideas have to be applied and Karl's important contributions. So I'm going to list them here and talk about them. And some of these things I've been interested in for a while. So what the ideal is to have an international monetary system without, and I put in quote, competitive devaluations. I think the best way to get that is to create what I would call a rules-based international system, where you kind of know the rules of the game that central banks are following. And how do you get to that? Like the easiest way to get to that is if you have in each country, you have their policy based on some kind of a policy rule. So then you would know what each other country is doing, at least the best that they can describe it. And it may be that they don't want to talk about exchange rates, but it's going to be clear when the statement is made what their policy is. So It's a long story, but I believe if you had a rules-based international system, which was simply based on an idea that each central bank provided a rules-based system, and that could be policy rules, it could be strategies, it could be many other things that revolve around a strategy for the central bank. And by the way, it could mean reacting to exchange rates. So Augustin Carstens, who's going to be the managing director of the BIS, has stated in Jackson Hole last year himself that there may be some reasons to look at the exchange rates if you're setting policy. So I'm not going to rule that out, but let's be explicit about it as we can. I think he would agree with that too. There's no sense in which this is saying that a central bank, any central bank, should follow a particular strategy. That's the decision of the central bank. This doesn't interfere with independence in any way, shape, or form, either internationally or politically, domestically. It's the decision of the central bank to describe its strategy. The word enhanced understanding is a direct quote from Mario Draghi, because I think there's a sense in which people can see the reason for this kind of a move. And enhanced understanding in this case is enhanced understanding of what each of us are doing as central bankers. There is in generally a lot of calls for reform. I mentioned Mario Draghi, which is at least mentioned in this way, but Paul Volcker wants to have a rules-based international system. He's out there giving talks. You have the former governor of the Bank of India, Reserve Bank of India, Raghu Rajan, calling for this. So there's a sense in which there needs to be some kind of reform, so it may be an opportune time, but in a way this proposal is mild, right? This is just all you got to do is describe what your strategy is and it will fall together. It's pretty remarkable if it's the case. Each country, each central bank, being explicit about what's best for each country and communicating that more broadly. And so that means you'll have less of this tendency to think about competitive evaluations, if in fact they are there. And they, of course, have been there in the past. We know that. Now, to make this happen, you need to have normalization, obviously. I'll call it global normalization, because this picture is not just the Fed, it's a global. And the Fed is beginning to normalize. I had a meeting yesterday where there was a description of the balance sheet normalization, and the interest rate has already moved from 0.25 to 1.25 or so, and maybe some more. So, and it's, as I think is very good and important, is a gradual and predictable approach to the balance sheet normalization. So that's all good. That's how you'd like it to happen. Is there any sense in which this will be global? Well, we don't know. But I think if there's a sense in which a normalization by the Fed will remove some of these exchange rate issues, and there'll be a normalization in the ECB, and there's already talk about that, by the way, if you listen carefully, and maybe even in Japan. And if that's the case, then you do have a situation where the normalization of policy, and by normalization I mean kind of back to a rules-based policy in the US and other countries, and that in turn will make it easier, I believe, for small open economies to deal with. It removes a lot of the turbulence that small open economies are facing. So the normalization there will, in my view, help normalization globally. So, but you do need to have a global normalization before you can have this reform, or it's part and parcel of exactly the same thing. Now, the last thing is perhaps most an issue, and perhaps most controversial. It says we should reestablish the connection between the policy interest rate and reserve balances. Okay, you saw in the picture how they're not related, at least anymore. It's certainly not in the Fed. The Fed can set the short-term interest rate by setting interest on excess reserves. It can do whatever it wants with reserve balances in that context. And in fact, right now it has no choice but to set interest on excess reserves because the balance sheet is so large compared to demand. So if they didn't set interest on excess reserves now, at the Fed, the interest rate would go back to zero. So they need that for the time being. And the same must be true of other central banks as well. But ultimately, that disconnect is a problem, in my view. It creates the ability to have these two instruments and perhaps do the things that are being revealed in my regression statistics. So I would like to think of as a long-term goal a balance sheet which is lean enough that it determines the interest rate like it used to. And so here, this is another reason to look at reserve balances rather than just at the whole balance sheet, because it used to be that the demand and supply for reserves would determine the interest rate. So if the Fed wanted to lower the federal funds rate, it would increase reserves and vice versa. And a very small amount of reserves were necessary for that. It's actually only 15 or 16 billion. It was very, very small. But it's possible to get back to that mode of operation, and it probably would be more reserves, to be sure. We don't know for sure. But it would be determined, the answer to the size of the balance sheet wouldn't be how big assets, it would be how big reserves are relative to demand. And if they were the right level, it would be determined the interest rate directly, and you wouldn't need to have another instrument to set the interest rate. There's a question, a very serious question now in central banking circles about whether this is feasible with post-crisis and whether money markets operate this way. I used to do research on the federal funds market. I believe it is feasible to do. There may be some liquidity restrictions or government regulations that have to be looked at, but I think it's feasible, again, thinking more about the US at this point, to run monetary policy where there's the disconnect between the size of the balance sheet and the interest rate is removed. And I think the same would be better for the BOJ and the ECB, and maybe even for small, for central banks and small open economies. And so that's the proposal. And in a way, these are going back to Karl Brunner, these are all implications of changes in institutions. So the first one is an international statement. Actually, there is a question, do you need an international institution to make the first thing happen? So actually, Karl Brunner would say no. He talked about things like this. You don't need, this is going to happen automatically if central banks each follow a rules-based policy. You don't need something else. I think maybe you might need something to watch over this, how it's going, to what's the terms for reporting your strategy, what does it mean to report a strategy, what does it mean to deviate from a strategy, because you don't want to rule out any of the deviations. So it may be necessary to have an international body. Maybe the BIS would be the best for this, to look over the whole process. But it is a statement of what's the best institution that would help be conducive to a rules-based international monetary system, and which would give the incentive to continue with it, to perpetuate it as long as it was thought to be necessary. Obviously, the second thing has to do with institutional things. What's the mechanism for, what's the best mechanism for the Federal Reserve and other central banks to normalize? And of course, the third is the institutional. There's an institutional issue. How do you put in place something that reestablishes the connection between the two? So they're all institutional, and they're how to make the ideas, if they're correct, work. And then finally, let me just remind everybody that this discussion of debates and reforms is an old one in monetary economics, one which I think is reminiscent of the debate which we are having, because we don't know what's going to happen going down the line. But reminiscent to me is the debate about flexible exchange rates and capital flows and independent monetary policies 60, 70 years ago. And so Ragnar Nurse argued that there was inherent instability in our exchange rate system. There was speculation, speculative flows, and that drove exchange rates around, and so you needed to have a fixed rate system, and therefore you needed to have no independence between central banks, or at least capital controls. Milton Friedman, of course, famously wrote, no, that's not the way to think about it. This capital flow volatility and pressures on exchange rates are occurring because of monetary policy. And if you got monetary policy to be more rule-like, and of course Milton Friedman had a famous rule for doing that, and you'd be okay. So you'd have capital mobility, rules-based monetary policy, and independent central banks globally. And that was what his argument was. And so it was a different view of what was happening internationally with respect to currency flows, with respect to exchange rate manipulation. And of course, they were writing in a time, especially in the 40s, when the experience, as Alan Meltzer indicated, of the 30s was competitive valuations all over the place. And that's really why the IMF was set up, to avoid those competitive devaluations in the future. So this is very similar. I think to many respects, Friedman won the debate at the time, but we don't know where it is right now. And then finally, let me just quote from the Karl Brunner again, because he, as you know, was famously interested in more rules-based or less activist kinds of policies. So this is written in 1980, and it's really sort of other reasons to think about policy I mentioned this way, but again informed by the models like the Brunner-Meltzer model, a model of monetary policy which was based in a lot of detail on credit flows. And so the products emerging from our professional work reveal a wide range of diffuse uncertainty about the detailed response structure of the economy. A non-activist, rules-based regime emerges under the circumstances as the safest strategy. It does not assure us that economic fluctuations will be avoided, but it will assure us that monetary policy making does not impose additional uncertainties. So, in conclusion, let me say that in a sense is the broadest message of these empirical results and the policy implications of the empirical results. Need a lot more research, provided some new results to think about. I think they're suggestive, and they coincide with many of my priors, which is probably why I like it most of all. So thank you. Okay. Thank you very much.
Well, thank you very much, John, for this really brilliant lecture. We all enjoyed it. It was a big doses of food for further thought, and you demonstrated again your big talent as an economist, researcher, but of course also with all your didactic skills.